Hello everybody and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. My name is Scott Plaskett and I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. In today's episode, I have an update call with Charles Wilton, a portfolio manager at Raymond James Limited, a Canadian subsidiary of Raymond James Financial. Raymond James is one of the most respected investment management firms in North America. I love speaking directly to portfolio managers about their process. Process is so important to investing, and when I can get a portfolio manager to explain their process in plain English, we all benefit from this wisdom. Now, here's the call. Okay, Charles, listen, thanks so much for taking the time today just to have a bit of a discussion on a new acquisition that we see in your portfolio, a company called Everest Everest Reinsurance Group. And I thought we'd just have a bit of a chat today about why you've decided to put this company into the portfolio. I know, recently you were disposed of a position, which we did a call on a little while ago called CR Bard. And so there's, extra cash that you have in the portfolios now. That you want to be deploying into some really attractive companies. So it looks like the one you've chosen at this point is Everest Re. So I thought we'd just have a bit of a chat on that. So I'll just, on that note, I'll just pass it over to you and you can give us a bit of an update on what this company is and why you decided to buy it.
Okay, Scott. Yeah, Everest Re is a workout company from the old Prudential life insurance company in 1973, and they, through its subsidiaries, are engaged in underwriting of reinsurance and insurance in the United States, and they're domiciled in Bermuda, but they have subsidiaries in Canada and Ireland and Brazil and basically all over the world. And they're in all kinds of different types of insurance, property casualty insurance, all kinds of general insurance. It's also a fairly small cap, a $7.5 billion market cap with 46 million shares outstanding. So it's a lovely little business that is very profitable. When we look at their 4 or 5 peer group competitors, and we look at the 5-year growth periods over that time, Everest Re has doubled their 5-year growth over its nearest peer. It's a wonderful little business, and it's becoming more and more profitable, and it's becoming more and more global. And as we've said on all these calls, really what stimulates the idea of buying or selling basically is the valuation. So yes, we have nice companies, we have companies that we like, but when the expectations get too high, we know, or because of the predictability factor, we don't want to ride that stock down. So if we have an opportunity to buy it back later, if it goes down, that's really great. And the flip side of that is the expectation, a very low expectation out in the marketplace. And how we look at the expectation is, again, we look at what the price is. And so when we look at the price in the marketplace, this is what the market is realistically telling you. And when we look at Everest Re, we see again that their economic book value is trading at 0.5 out of 1. So that means that the market is expecting Everest Re never to make any money ever again. Now, we look at the return on invested capital on Re, it's 18%. Their combined ratio, that means, if the combined ratio is trading under 100, that means that the company's making money after its losses and after its expenses. And Everest Re has a combined ratio of under 1, so it's profitable. And from time to time, we see, for different reasons, the ability to go in and pick up these kind of companies that are basically under the radar, in which case the reason that we're buying Everest Re.
So let me just see if I can just put it into my own terminology here. So and correct me if I'm wrong. So what you're saying here is that when you've determined the economic book value is currently at 50% of what the company should be worth in your mind?
Right. Based on the company's earnings.
Yeah.
Now, there's a big distinction here. Economic book value versus book value. Those are two different things. Economic book value has to do with the ability of the company to generate profits over the last 12 months. This is net profits. It's not book value of what the inventory thing is. It's not book value. It's not business book value. It's economic book value. So what we're doing is we're playing off the actual money that they earned over the last 12 months and what the market price is saying about that. Okay.
So then the market is saying, for whatever reason, and I don't know if we even know what the reason is, the market is saying, oh, this company is, its price right now is much lower than what you feel it should be trading at. And the market is saying, well, we don't feel this company is going to make any money going forward. Yet when you take a look at the return on invested capital, you're seeing an 18% return. And the market's saying, well, no, there's not going to be any return. But in actual fact, there has been return. So when you put all that together...
Well, yes, because when you look at if the economic book value was one,
mm-hmm.
that would mean that the company, that the marketplace expects the company to do next year what they've done last year or the last couple of years.
Okay.
When the economic book value would be 2, that means the market is saying it's going to double.
Right.
It's so expensive, but the expectation is there that it's so great, it's so busy that it's going to double. But when we get under 1, the market price is the marketplace is saying that from a cash point of view, it's not going to make any money.
Right. Wow. So,
well, they're already making cash. Now, here's the secret. The secret is when you do the evaluation, it's the way that you do the evaluation, and this is what we talk about when we're looking at reconciling the GAAP accounting against the economics of the business. Now, lots of people would go in there and look at that and try and figure that out, but they wouldn't have the number. They wouldn't be able to get the numbers to come up with the evaluation of 0.5.
Mm-hmm, mm-hmm.
Because you got to go through 80, 90 pages of footnotes and rebalance everything to get to the point. So our ability to be able to look at the business value, the cash business value of what the business is actually doing versus the accounting principles, we see a huge disconnect.
Right.
But it's the way that we do our evaluations that allow us to find out what that disconnect is.
Yeah, and I mean that's the deep dive you've always talked about. It's the ability to go.
This is it.
Yeah.
This is why, for the most part, it's mostly about evaluation.
Yeah, and
about price.
Therein lies the reason that most people aren't able to make good decisions because they're not doing the research, they're not doing the deep dive, they aren't able to get these numbers and say, wait a minute, I've got a company here that's trading at half what it should be worth, yet it's been growing with return on invested capital of 18% over the last, I guess that's the last year. So that and when you put the other criteria, and there's other criteria that you're using as well. It's not just the numbers. You've got a filtering process that won't let certain companies even into your profile. Because exactly. So there's other things that go along.
Yeah, with it. Einstein said, make sure things are simple, but not simpler. So right. The way that we're presenting it here is the culmination of the deep dive coming down to a way that's very easy to explain to someone.
Right.
But when we get in the deep dive trying to figure out, what do the rising economic earnings mean, and what does that mean, and what's the growth appreciation there? But when we boil it all down, we just want to find a business that is mispriced.
Right.
But it has to have a predictability factor from my point of view. So now there are businesses that look very good to buy, but I won't buy them because I don't like the businesses.
Right.
So you see the predictability factors of the portfolio over time. You see we're very consistent on this. I don't have retail kinds of stocks. Mm-hmm. We know we don't buy resources. We know we don't buy tech. But retail, for example, these stocks can cut in half by 50%, whether it be Target or be somebody else, even though the numbers look good at today's rate.
Mm-hmm.
So I'm doing more from the standpoint of would I like to own the business forever?
Right.
What's the moat? What are the reasons you're buying? Why is the company of a very high barrier of entry? Why is the company predictable? What is it about it that separates it from something else?
Mm-hmm.
These are the businesses that we like. So yes, the numbers are the actual starting place. Because you could imagine that BlackBerry at one point had really great numbers because it's coming off.
Sure, yeah. I mean, the numbers must have fallen into a nice category, but it would never show up in
your
your portfolio.
You're unbelievable to buy this company. 2 cents on the dollar. It's fantastic. Look at the growth rate. The trouble is that the growth rate fell off 99%.
Right.
But that's in the future. So yes, you're right. When there are more criteria we look at when we evaluate businesses.
Yeah, great. Well, that's super. Well, was anything else you wanted to touch on with regards to this company? And I mean, it looks great. The numbers look great. Your deep dive is obviously making it worthy of putting into our portfolio. So, any other comments or questions you want to or statements you want to make on this company?
Well, only that if one took a look at the history, even the last 10 years of the buys and sells, they're very consistent, very predictable. Very good returns, very high degree of safety. But I laugh at a lot of people. They say, yes, but it's so boring.
Yeah,
well, that's the whole idea, is it being boring.
Yeah. Well, that's great. Yeah, boring is good. If it can just do it year after year after year, and then the market gets kind of tired of it and says, oh, no, this isn't doing anything. It's so boring. Yet you can pick it up for 50 cents on the dollar. Hey, that's boring is good when it comes to making money. So, well, that's great.
Well, as we said in our last buy call, I think, was IBM. And there's been a lot of press on IBM that the servers are going down, the hardware is going down, the cloud is very competitive, and it looks like IBM could wind up, on a steady downturn, and maybe over the next 4 or 5 years have a very, very major problem. And this is what the view is for a lot of people and a lot of professional people out in the marketplace. But if you do a deep dive and understand what IBM does, it's the most unbelievable company. There 70% of the Fortune 500 deal with IBM, and they were so locked into IBM that they couldn't leave even if they want to.
No, on that point, when you say that percentage of the Fortune 500 deal with IBM, in what capacity do they deal with IBM?
IBM. Here's an interesting thing. This is a whole idea about going so far and then not going far enough to really understand what's going on. We have a tendency just to have shortcuts in our brains that allow us to move on and do other things, so we don't really do deep dives. So IBM has servers, obviously, and the servers account for 4% of their revenue and 40% of the profit. And the reason is, for example, Visa. Visa is locked in most of the banks, most of the financial institutions on the planet, or certainly North America, are locked into IBM. They couldn't change even if they want because of the security and what they've done. So Visa, IBM operates about, I think, 25 or 56 or 60 million transactions a day for Visa. And they have for 22 years. And not 1 second in 22 years has the server gone down or there's been one problem.
Well, let me ask you this question, and I know because it may be on somebody's mind who's listening to this. You hear IBM, you think technology. You just stated you won't buy technology.
Yes, IBM is more of a service company.
Yeah.
It's not a technology company like a Cisco or a hardware company. What they're doing is they've moved mostly out of the hardware, the computers. Remember the IBM computers?
Yeah.
What they do is, and this has been a change over the last 8, 9, 10 years. Now they're a service business. So what they're doing is they get paid for the service. So if you're the Royal Bank or you're a bank and you need security and you're locked into IBM because of the sophistication of IBM. So it's not a tech company in terms of them selling the technology. It's a service business.
Yeah.
Now where they're really building is on when you hear people talk about the cloud, there's nothing in the cloud. All it is a bunch of servers in a room. So if the servers double, then you get more space, that kind of thing. But really, it's just a warehouse with a bunch of servers. And what IBM has is they have Watson. So Watson was really built as a science project to compete in Jeopardy, to beat them, and you know that they beat them.
Mm-hmm.
So Watson is a invention that no one's even come close to even understanding what they're doing in terms of competitive nature. So Watson the competitive advantage that IBM has with Watson and its server industry is almost the same kind of a moat that Coke or Walmart would have. In other words, you're not going to get into that business.
Right.
And the thing about Watson is that, for example, the medical industry doubles its knowledge every 5 years. But what happens is all that knowledge is coming from doctors and nurses and specialists and pharmacy companies and all kinds of things. It's all unstructured. So it's just coming from all over the place. What they will do now, and IBM is working with Sloan Kettering and Johns Hopkins, is all the information is going to go into Watson. And Watson's ability to be able to learn from the information that it's putting into it. And there's no competition anywhere on the planet for Watson.
Yeah. Well, I mean, that's amazing. I mean, and that's again part of the deep dive, and that's why I brought it up, because again, people initially they hear, oh, you don't look at technology, yet you've got IBM, but they haven't realized that IBM has moved from a technology company to a service company. And they've got such deep roots into all the companies who they work with that people just the predictability of that cash flow is going to just continue and continue and continue.
Well, somebody that creates 40% of their profit from 4% of their revenue, and it's locked in. So there's no bank. Mm-hmm. They own the financial industry, and obviously the financial industry needs security and they needs predictability, and that's very important. So all the years that they've been operating, it has not been down once.
Yeah.
And they're so locked into them that the moat is so deep, how can you get the business away from them? All you can do is start increasing the business. And now with Watson coming on the cloud side, if they looked at $1 billion, they put $1 billion into Watson in a not too distant past. So if they're looking at $1 billion in revenue in Watson, that's not very much revenue, but they're looking over the not too distant future of 16 to 20 billion a year in Watson alone.
That's amazing.
And this is also something that a lot of people don't even understand.
Yeah. Because
it's so sophisticated. The real starting of artificial intelligence.
Yeah.
Dealing not with structured information, unstructured. So yes, people can have Oracle, or somebody can have a server farm, or what we call the cloud. They can have structured information, credit card numbers or detailed numbers, structured information going in, and they can store it and they can manipulate it. But what they can't is they can't manipulate unstructured information in a way that the entity learns while it's doing. So when you look at the education industry and you look at the medical industry alone, that is unfathomable.
That's very cool. Very cool. Well, listen.
And now that's a story about IBM. But IBM, that's out there for everybody to see.
Yeah. And
yet, when you look on and you see the repercussions, people have got cells on IBM. IBM's over. IBM's dead. It's finished. The new CEO, Jenny, can't run the company properly, and it's just an old burned out server company. That's not what's happening. And the other side of this as well, as long as the valuation is the same, as long as the valuation is good, this is the long-term thing that we think about. I would like to own IBM as they do now and never sell it. Mm-hmm. So if we can grow with the business over time, that's really great, except when the market gets really excited about what's going and really overvalues it, well, we know that what's really important in the market is reversion to the mean. So when the expectations get too high, then the expectations have to come down. When expectations are very low, then they have to come up. So reversion of the mean is very important in the investment business, along with luck and along with the continuum of what you think and skill and luck is. So when we get on the undervalued side of a really great business, we like to just hold on to it until it gets really overvalued.
Yeah, and then you give it back, and that's the logic behind what I love about the deep dive that you do is that you know when the right time to buy is, and you know when the right time to sell is, not because of the noise that's happening in the marketplace, but because the metrics are telling you that.
Do you know the average? Good morning, sorry.
Oh, sorry. Hang on one sec. I think the internet dropped out there for a second. You want to say that again?
Okay. Morningside just put out something that was very interesting, and this is something that I've looked at in my research before. When you look at the average return of a mutual fund, say throughout the 2000s, say the average return for a mutual fund was say 5.2, I think it was. And then the S&P was up at 6 point something or whatever. And then you looked at what the return to the investor was on the average mutual fund. It was 50% lower. Mm-hmm. And the reason is this: is people are guided by their irrationality and fear and greed in terms of their investments. So when it looks like the market's going into the sewer 2008 or whatever, people are jumping out. Then they're trying to jump back in when it's high because they see it's up the last 3 or 4 years and they want to jump on it. Now, do you think people would learn from this over the last 100 years if you look at the actual patterns?
Yeah, you'd like to think so, but it's just patterns just keep on showing that no, they don't learn their lessons at all.
They don't, because it has to do with emotion.
Yeah.
So it is not to do with rationale. So when we look at businesses, we like to look at it from a rational point of view. What is the entity? What's the business? What's the moat? What's the barrier of entry? What is the valuation? And try and keep the emotion out of it.
Yeah, that's a very logical process. Well, listen, thanks so much, Charles. I don't want to take too much more of your time, but I appreciate you going through this. I didn't realize, we had no idea we were going to sort of go on this tangent with the conversation, but it was good. It really sort of provided some insight into, more information on the back end. So about the deep dive, and it's just nice to have that conversation. So I appreciate you taking the time today, and I look forward to talking to you again soon.
Okay.
All right. Thanks,
Talk
Charles.
to you soon.
Yeah. Bye-bye.
Bye.
Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment and we'll respond directly online. If you would like to take advantage of a free, no obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter, twitter.com/IronShieldCFP. Like us on Facebook, facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.